There's a pretty big question around of when we ever get money, such as, should this money go towards stocks or should it be placed into bonds? We're going to look at the opinion of Benjamin Graham, this guy right here. Now, he's a pretty conservative investor who's primarily focused on just two things. Number one being the safety of your principal, and number two being adequate return. So as long as you have those two conditions, he feels that it's a pretty good choice. Now, this goes back to our original question. What do we do with our money, stocks or bonds? What does he prefer? Well, he actually gives the general suggestion that 50% should be in bonds and 50% should be in stocks. However, he also talks about the maximum limits, and he says there's a maximum of 75-25 split between stocks or bonds, depending on a few outside forces beyond the general suggestion. So you might be asking yourself, well, which split should I choose? Well, if you're younger, then definitely having a wider exposure towards stocks since your time horizon's longer would make more sense, versus if you're older and you would prefer to have a more stable income with the bonds. Additionally, there's also risks such as, are you taking care of other people? If you have no children, then you could focus a little bit more on stocks because there's less of an immediate need to facilitate your cash into whatever they need at that time. Versus if you have like 8 kids, then clearly having a more stable and reliable vehicle would be much better. So ultimately, the choice is based on two factors. Number one, your investing time horizon, and number two, your risk tolerance. So why would we go about suggesting this? Well, number one is the financial reason. It helps mitigate risks, and you place capital in stocks when markets go down and away from stocks when it's too high. And number two is psychologically. Having general plans helps us think better and helps prevent us from making really rash decisions. So let's go into how this works over time. Let's say you chose the 50-50 split with $10,000, meaning 5,000s in one and 5,000s in another. And each month you're making $500 additions to your portfolio. The money goes towards the security that is needed to maintain your given percentage. So for example, let's just go 1 month out. Let's say after 1 month, stocks go down $600, but bonds go up $200, and your total dividends and interest is $50 for that month. Now, of course, as we mentioned before, your cash deposit is the $500 from before, meaning your total stock, since it went down $600, is $4,400, your total bonds is $5,200, and your total cash from your dividends/interest in addition to your cash deposit is now $550. To go back closer to a 50-50, all of our cash that we got from the dividends, interest, and cash deposit goes into the stocks since it went down that month. So our portfolio's end of month balance, the total value is $10,150. Stocks are now sitting at $4,950, and our bonds are sitting at $5,200. Selling off stocks and bonds to maintain our balance of 50-50 would only be if there's a notably large gap, but this seems close enough. And then you just continue this process each month and continuing on until retirement. So if you enjoyed the video, subscribing and hitting the bell for notifications is greatly appreciated. And if you liked the video, definitely leaving a like or comment would be greatly appreciated. So once again, thank you, and I'll see you in the next episode.